Charlie didn't enter crypto to speculate. He entered to protect. $218,000. 11 months of disciplined savings. A civil engineer with predictable income and a structured life, he wasn't chasing 10 times returns or trading obscure coins at 3 a.m. He wanted somewhere stable to park his dollars, outside a system he felt was weakening. So he chose an exchange. The app looked institutional. Clean interface, billions in monthly volume, millions of users, 3 years in operation, glowing 5-star reviews. It felt established, permanent, bigger than risk. He downloaded it, logged in with fingerprint ID, transferred his savings, and watched the balance update instantly. Smooth, efficient, reassuring. He believed his money was in safe hands. That belief was the first mistake. When Charlie deposited his funds, he assumed he owned Bitcoin, his asset, his property. In reality, he owned a claim, a database entry inside a private company's internal ledger, a promise that said he was entitled to withdraw that amount upon request. As long as most users never asked for their money back at the same time, the system worked. It looked stable because it rarely faced stress. It resembled banking, but without regulators, capital requirements, audits, deposit insurance, or government guarantees. The exchange had none of those constraints. Charlie didn't know that. He saw size, growth, volume, and public confidence. He thought a company this large wouldn't risk cheating its users. For months, everything functioned perfectly. Markets were rising. Liquidity was abundant. In bull markets, solvency is never questioned because growth hides structural weakness. Charlie checked his balance every few days and felt satisfied watching it sit there, steady and intact. He even recommended the exchange to colleagues, confident in his experience. Stability, he believed, had been proven. Then one Tuesday afternoon he came home from work, opened the app, and clicked withdraw. The request processed. Nothing moved. He refreshed the page. The balance still showed $218,000 in the same clean font, unchanged. He tried again. The status read, pending. He assumed it was network congestion, minor friction. These things happen. He made tea, returned 10 minutes later, and checked again. Still pending. Support replied with polished language, temporary congestion, security review, network delay. Professional tone. No urgency. No alarm. He decided it would resolve by morning. It didn't. He woke at 3 a.m. and checked again. The number was still there, but something felt different. It no longer felt like money. It felt like a picture of money. Over the next few days, he refreshed constantly. He joined Telegram groups, scrolled through Reddit, watched rumors form and dissolve. Some users pointed to unusual on-chain wallet movements weeks earlier, large transfers, reserves shifting. The data had been public. Interpreting it required expertise. Charlie had seen those posts and dismissed them as fear-mongering. Panic spreads faster than facts, he had told himself. He kept his funds where they were. What he learned too late is that exchange failures rarely explode overnight. They suffocate. First withdrawals slow, then explanations multiply, then limits appear. Then communication becomes vague. Finally, silence hardens into permanence. The system doesn't collapse with a bang, it erodes until confidence evaporates. Charlie had enabled every security feature available. 2-factor authentication, strong passwords, email confirmations. He believed security meant protection from hackers. He never considered the larger vulnerability that the institution itself might be unstable, that reserves might be incomplete, that liabilities might exceed assets, that his deposit had legally become part of the company's balance sheet. When he finally read the terms of service closely, buried in the legal language was a line stating that in the event of insolvency, user assets could be treated as property of the estate. In the third week came the announcement. Withdrawals were paused while the company restructured. The word was carefully chosen. It didn't admit loss. It didn't say bankruptcy. It implied temporary inconvenience. But markets understand language. Restructure is often the final stage before reality sets in. Charlie stared at the announcement for a long time, understanding that temporary can stretch indefinitely. The balance never disappeared. That was the cruelest part. The app continued to display $218,000 as if nothing had changed. The number glowed with the same confidence it always had. But it no longer represented access. It represented a claim in legal limbo, a digital artifact detached from control. It took Charlie 4 years to recover financially. Extra shifts, freelance projects, deferred vacations, reduced expenses, watching peers move forward while he rebuilt slowly from zero. He didn't talk about it much. The loss was complicated to explain and easy for others to judge, so he absorbed it quietly. Today, he keeps his savings in a regulated bank. The balance is smaller than it once was, but when he transfers money, it moves. When he withdraws, it arrives. The difference is simple and profound: accessibility. Ownership proven by movement, not by display. What Charlie eventually understood is that the system wasn't broken by hackers or technical bugs. It was vulnerable by design. Remove oversight, and risk doesn't disappear, it shifts. It moves from institutions designed to absorb failure to individuals who cannot. Exchanges offered convenience, and users traded custody for it. Most never notice the trade until the moment they test it. Across the world, millions still hold balances on similar platforms, confident in volume statistics and polished interfaces. The numbers look identical whether they represent secured assets or unsecured promises. On a screen, there is no visible difference between custody and credit. The last time Charlie logged into that exchange, the dashboard still displayed $218,000. Same font, same formatting, same silent promise. He closed the app and uninstalled it. Not out of anger, but out of clarity. The most expensive lesson of his life cost him $218,000. He learned that convenience is not protection, that size is not safety, and that a balance means nothing until it moves. Some numbers represent assets, some represent obligations. They look the same in digital form. The only difference reveals itself the moment you try to leave. Every day, thousands of people just like Charlie open an app, see a clean interface, read 5-star reviews, and transfer their life savings. They don't know the difference between an asset and a promise. They learn it the hard way, the moment they try to leave. Charlie didn't share his story for sympathy. He shared it so you don't have to learn the same lesson. If this video made you think, even for a second, about where your money really is, then do one thing right now. Hit subscribe. Not for me, for yourself. So you don't forget what balance really means. Comment below. Have you ever tested your exchange? Do you know if your money actually moves? And share this video with one person who needs to hear it. One person you don't want standing in that creditor line. Because the system won't change until enough people understand the trade they're making. Convenience is not protection. Size is not safety. And a balance means nothing until it moves. Some numbers represent assets. Some represent obligations. They look the same in digital form. The only difference reveals itself the moment you try to leave. Watch the full video again. Send it to a friend. Take 5 minutes today. It might save you 5 years tomorrow.